IPO fever behind the scenes. My name is Jonathan Morris. I'm a corporate finance partner at the international law firm Berwin Leighton Paisner, and I specialize in, amongst other things, IPOs. And we have with us this afternoon a very distinguished panel, and I'm going to invite each of them to introduce themselves. So, John, would you like to kick off?
Good evening, everybody. My name is John Millar. For the last 6 months, I've been running the primary markets team at the London Stock Exchange. Prior to that, for most of 30 years before, I was an investment banker focusing on capital markets and doing most of that in London since 1991.
Thank you, John. Victor?
Good evening, Good evening, everyone. I apologize for annoying you with my voice, but trust me, it's more annoying for me. I'm an editor at Forex Magnates, and I've been an FX trader for 10 years. And in the rise of the financial crisis, I also turned my eyes towards equities. Hence, I have a different perspective on the market. I'm on the other side. After you go public, I'm going to be judging you.
Thank you, Victor. Michael?
Hello, I'm Michael Rosenberg. I've been both poacher and gamekeeper over time. I started life in a merchant bank many years ago. Actually spent 3 years as an FX trader and 3 years as a gold and silver gold fixer, and then moved into corporate finance. I was very involved in the 70s in the deregulated days in bringing IPOs to the market. Then went off and founded my own healthcare company, which became a global business. Came back and was a founder of what is today Numis Securities, and did some more IPOs there. And these days, I sit on the fence usually as a non-exec director of a number of companies.
Thank you. My name is Mark Cohen. I work for an international PR communications and investor relations consultancy called Crayab Gavin Anderson. I head up the financial communications team in London, where we specialise in IPOs on all major exchanges and other capital markets work.
And finally, Chris Searle, a partner in the capital markets team at BDO, the accountants. BDO is the 5th largest firm of accountants in the world, and we are also the leading reporting accountant for AIM IPOs.
Great, thank you very much indeed. Before we kick off with some questions, just so we get a sense of who we have in the audience, how many of the people here are looking at IPOs in London? How many of you are prepared to admit that you're looking at IPOs in London? Okay, so a relatively small number, I think, would be the conclusions.
Any guys own companies? Any CEOs out there? Excellent. All right.
Okay, we're going to kick off with the first question. I'm going to start at the far end, and we're going to work our way along. What do you regard as the main advantages of going public? Chris?
I guess, firstly, the ability to raise funds to fund the organic growth of the company. I think that's the number one reason for companies going public. In terms of an exit for existing shareholders, it is possible, but it depends on market conditions and the demand for the company's shares. It is also possible to use the company's shares as acquisition currency once the company is on the public market. The valuation gives an incentive for employees to enter into option schemes. And then finally, an advantage is often overlooked. It raises the profile of the company, so it gives it more credibility with customers and suppliers.
Okay, thank you, Chris. Mark?
That was pretty comprehensive, Chris, but I suppose I would emphasise the point around credibility and profile. We see a lot with clients who are looking to negotiate commercial contracts, particularly smaller companies, or looking to hire people as well, because there's sort of incentive plans that can be brought into place as well. So having a listing on a major exchange, be it AIM or another one, can certainly help with credibility.
Okay. Michael, from the perspective of a non-exec director?
Yeah, I mean, of course, all of those are absolutely correct. The corporate profile is, as you say, often overlooked. But I think in addition, when you're looking to recruit senior management, you can offer them the opportunity to have options and many other incentives that may or may not have any value in a private company.
Okay, and Victor, from the sort of outside perspective?
Well, I think that we have to say here that there are also disadvantages of going public, especially for the FX industry where things are kind of usually kept very, very private on what the companies are doing in terms of real volumes. Many of them only release growth numbers and no concrete figures as to what their revenues are. So if you're considering it, you have to forget about it. And also, you might value your voice, your opinion about your company more than going public and sacrificing it for equity.
Okay, very realistic perspective. John, do you have anything to add?
It may have already been covered, but just to add the extra point of an acquisition currency. If you're a public company and you're growing fast and you want to grow through acquisitions, you can use your shares very rapidly to do that. Chris's main point is the key one, though, for why you go public, and it's very simple to get yourself permanent capital. If you're growing your business and you want to own it, you want to develop it, you need to keep your capital. You need to grow your business and hold on to that. If you're doing it yourself, you're doing it through venture capitalists, private equity firms, you got to give that money back at some point, and you're always focusing on an exit. Once you go public, that money is yours. It's there to build your business on. You don't have to give it back. Your investors who want an exit trade in the market overall. So that's the fundamental reason.
Okay, thank you. How does one decide whether to float a company in London, New York, Frankfurt, elsewhere? John?
London, of course.
But how does one decide?
There's a whole number of reasons or issues. First and foremost is which market is most suitable for you. Keep in mind when you're going into a market, you're the issue, you're the seller, but you need the investors to line up and to buy your stock. So you need to go to a market where they're going to be familiar with your business and familiar with the concepts and the drivers of your business overall. So find where the most natural home is, find where there's comps overall. But you know, going public is an ongoing responsibility, and it's a big one. So also think about key issues of where do you want to live? Where's your management? Where's your board? Whose governance do you want? If you built your business here in London or in Tel Aviv, do you really want to be flying out to New York every single time you want to do an announcement or something? So yeah, at different stages of your growth, at different stages of your development, different markets make more sense overall. But find where there's comps, where the market understands you, and where they'll pay a fair multiple for you.
And John, just because we're sitting in London, because you're a representative of the London Stock Exchange, what do you regard as the key advantages of London over some of the other exchanges we've mentioned?
Well, the main one is an accident of history, and that's the time zone. We sit in Greenwich Mean Time, which means this is the one place in the world you can trade Asia, Europe, and the United States all during a trading day. It's also as a result of having very, very good corporate governance, very, very good legal practices, and precedents in place. It's a place where people are happy and comfortable to invest, but they don't think they're going to lose their money by investing. So as a result, the world invests here. You take your company public in London, investors from the UK, of course, from Europe, from Asia, from the US, all will be in your transaction. You can access them all. If you go to the US, it's largely going to be a domestic US investor book that you have in there. If that suits your business, great. But if you want to have your stock embedded in a market that understands international businesses, international capital flows, this is the place to be.
Okay. Michael, obviously you're on the board of a number of international companies which are listed in London. When deciding to become a non-executive director of some of those companies, I appreciate some may already have been listed, but when asked by the board, should they list in London, should they list elsewhere, how do you help advise them? Okay, well, obviously geography is important, and several of the companies I've been sitting on the board of are Israeli-based, and Israelis are global operators, and traditionally have tended to go to NASDAQ or to the American Stock Exchange. In fact, I was one of the first people to bring Israeli companies to London back in 1995 when AIM first started. And it was a struggle because it didn't seem natural to them. But then it became obvious because I think the point that you make is very valid. Time zone is important, the ability to trade in one place. Distance is another one. And what is always underestimated is the time that's taken to be a public company. I mean, you have a job as a chief executive or CFO, and you have another job, which is to deal with
the shares that you've introduced to the stock exchange. So you have to be aware that you are going to be asked to make presentations regularly. So location is important. If you've got to go to the States every 5 minutes, or not every 5 minutes, every quarter, that's a big issue.
Chris, from the perspective of the financial advisor?
I mean, I would say London as well. And, so, you know, London's got a very robust corporate governance system, a very robust way of doing IPOs. It's often said that companies can obtain a higher valuation going to the States, but I wonder if that is in fact true. I mean, I was at a seminar last year where a Bank of America Merrill Lynch guy stood up and he said, it's a myth that you get a higher valuation in the States over London. He didn't explain why, he just said it's a myth. But I think it's encouraging he can say that. So I think you know, companies need to think very carefully as to which market they go to. And I think London has everything that most companies from anywhere in the world can want from a capital market.
I just want to come back to John on that point here about valuation. Is that a fair analysis in terms of London versus New York?
Yes, but it is a myth. You got to remember that this is you guys in particular know that information travels very quickly. Information is transparent. So if you're sitting here in London analyzing the right price to pay for a stock, you're looking at the same information the guy in Seattle is, the guy in Boston, New York, France, Paris, Frankfurt, whatever else. Everyone's looking at the same information. Everyone's looking at the same comp. So it's not magically the multiples double as you go over. Everything's calibrated to growth. Everything's calibrated to the opportunity that your business has. So if you are a super fast growing business addressing a very profitable market niche that you're going to exploit, you're going to get the lion's share of it, you're going to get a great valuation wherever you are. If you're a slow growing company and you're looking and comparing yourself versus a super fast growing company out in Silicon Valley, of course you're going to have a different valuation, but there's a reason for that. So it's all very much, you know, you have to look at an apples to apples basis. So if you take 10 companies growing at 50% in the US and compare them against 4 companies growing at 20% here, they're going to have different valuations. But the ones growing at the same percentage with the same margins are going to be very similarly valued and arbitraged out.
To Mark, can I ask Victor, you're slightly distant, I guess, from one of the advisors or the market itself. What's your perspective in terms of which market companies should decide to float upon?
You know, from the perspective of being an industry insider with FX, I would say that it depends very much on the company, on the type, because we have technology companies and we have also brokerage companies. So if it's a financial related company, I would choose London for obvious reasons. Global regulation, building a great brand. We already have examples that it works of listed companies, brokerages. But if you're a technology provider, I would probably choose the US because it's an established market, and there is more adventurous investors there, I think.
Okay, there may be some different views about that on the panel. Mark, what's your perspective in terms of where to list?
I think in my experience, okay, it's actually even more nuanced than that. I think it's a bit too broad brush to say that you get one better valuation in London or a better valuation in New York. As Victor was alluding to, really does depend on the company in the sector and even the subsector within that. So if you take technology as a good example, in general, tech companies might see better valuations in the US market, but if you break the sector down, online gaming, for example, is far better in the UK, apart from the fact it's actually illegal in America. There is a much better understanding of gambling, particularly sports betting in the UK market, which is why you've seen a lot of companies come here. But when it comes to other software providers, particularly social media, it's in the US. If you look at something like ad tech, then again, the UK becomes more preferable. And I think what it boils down to is the understanding that institutional investors in a given market have of a company. And the more they understand and believe in a company and understand what it does, the better they would appreciate the value. And that is obviously where communications comes into it, helping the market appreciate and understand the company. But there are certain investors and some markets where they have a more innate understanding. So things like mining, energy, oil and gas. You would look at perhaps Toronto as having a better valuation to the US, and certainly London, financial services, again, London. So I think it really does very much depend on the specifics.
Okay. Moving on, what are the key characteristics that a company needs for a successful IPO? Michael?
Well, it's a big question, actually. First of all, I think clearly the right management team, a team that people can have confidence in, that they'll believe in, and a team that is able to deliver what they say they can deliver. One of the great criticisms of many companies who come to the market is over-promising. And that's a hard subject because, by definition, when you are promoting your company, you are trying to be as optimistic and as positive as possible. And many management teams fall into the trap of over-promising and then under-delivering. So it requires a lot of help and advice to avoid that situation from occurring. Of course, there are many other situations that dictate whether you are the right company to come to the market, and I think that they come down to the ability to be transparent, as opposed to being a typical, if I may call it, a typical entrepreneur who runs his business with a very sort of closed shop and doesn't want anyone to know what he's doing. That's fairly normal, but it's a big jump to go from there to being transparent.
Thank you, Michael. Mark?
I think obviously there's the technical aspects of what you need to do from a financial and due diligence perspective, but to a certain extent, I think as Michael was alluding to, that's a given. I think credibility and reputation are an extremely important part of what you need to do to come to market, and I think too many people underestimate that. You know, you start off, you might be a very successful entrepreneur, but when you become a public company, almost the clock is reset to day one. And what you've done before is less relevant to what you then do afterwards. And continuing to meet expectations and continue to build credibility slowly and painstakingly with the market, visiting at the right times, going through the right steps, having the best practice and taking the right advice is an essential part to having a successful listing on an ongoing basis, not necessarily just a successful pricing of the IPO.
And Victor?
Well, I would say that it takes a lot of honesty to be successful public company, or at least pretend to be honest so people believe you actually. We have plenty of examples that of these things actually not happening. So, like the panel said already, it really takes a lot of will to become transparent. And this is very difficult, I think, especially in this industry.
Chris, do you have any thoughts in terms of what makes a successful IPO?
As an accountant, I look at the financial record of the company and say that it has to demonstrate strong growth in revenues and profits in the last 3 years, and a very good prospect that those will continue, if not accelerate, in the years after the IPO, coupled with strong margins and a good competitive position in its marketplace, which could be protected by intellectual property and so on.
And John, from the perspective of the stock exchange?
I think you can sum all this up by saying a good business, a passionate management team, and a plan that's well executed. That's what you really need. But keep in mind, as you're taking your company public, you guys are in love with your businesses, you're passionate about your businesses. Investors want to make money. They're looking at returns. They're not looking at companies, they're looking at stocks, they're looking at financial investments. So that's how they'll measure you. They'll look at you, can you grow? Can you penetrate a market farther? Can you do it profitably? And then you'll win them over and go through. But the key message overall in going public is focus on your business. That's what really drives all the way through. There's plenty of advisors to help you with the other stuff. Make your businesses work, make them profitable, and be passionate about them, and then it'll work well for you.
I guess in judging whether or not an IPO is successful, different people will look at different times. Some people will just say, oh, we've listed, that is a successful IPO. But really, you need to wait, you know, a period of time to see whether the company has actually made the most of its public listing.
The key thing, guys, here is it's not a zero-sum game. It's not like a trade where one side wins and one side loses. Going public is a relationship. It's like getting married, having a kid. You got to be prepared for it. You got to know what you're getting into, and you got to do it properly. And if it does, then bliss comes. If you get any of the things wrong, if you go into it before you're ready, it's a disaster, and it can sort of cause lots of problems for you going forward. So you have to take it seriously. You have to realize it's a long-term relationship and then nurture it.
How should one decide which advisors to engage for a flotation? Chris?
I'd say advisors that are very experienced in doing IPOs. Obviously, on the accounting side, I'd say BDO, since we are the most experienced accountants in London. But from a broker perspective, they are the guys that are going to raise the money for you. So I think there are two aspects you need to consider there. Do they have expertise in your sector? So do they have an analyst that can write the research note for the IPO and then follow you after the IPO? And then do they have a good fundraising record?
Michael?
Certainly the analyst is important. It's very important, so both before and after the listing. And the other factor, by definition, is a good sales team. You need your stock to be promoted actively. Beyond that, I think it's fair to say that anyone who's qualified as a nomad should have the skill base to be able to take you to the market. So it comes down to chemistry at that point, whether you get on with the people or not.
Mark, from the perspective of the financial advisor, the financial PR advisor?
Yeah, I mean, I think a number of factors come into play. I think, to Michael's point, chemistry is extremely important. You spend a lot of time with people in the run-up to an IPO, and you have to get on with them, otherwise it's frankly quite a difficult process. Also, particularly when it comes to the media side of the financial communications, I think trust is absolutely essential. As an executive, you're putting your reputation into the hands of someone. Your wife, your children, your friends will read this stuff, and if the articles are positive, obviously that's very nice. If they're negative, then that's quite awkward. So it has to be someone who you really trust if you're going to ask them to put you in front of a journalist and talk on the record about your business. So trust, experience, and obviously good relationships with the key stakeholders.
John, I appreciate from the exchanger's perspective, you would say obviously probably have very experienced advisors who are used to the IPO process, but also, of course, you have an investment banking background. Anything to add in terms of choosing your advisors?
I think the chemistry point mentioned earlier is absolutely essential. But let you know a dirty little secret of my former industry, make sure you don't get the bait and switch. Make sure the people who pitch to you, who say they're going to do your deal, or they're going to be the ones who do it, and make sure you like them. You want to work with them because they're going to be your trusted advisors for 6 to 8 months, at least in the process. So if you don't trust them and it breaks down, it's a disaster. Also, don't be penny wise, pound foolish. Don't try to negotiate too hard with them, because if you end up getting too many advisors in the process, particularly too many banks, there's not enough in it for them to actually take you seriously, and you end up getting a substandard service in the B team. Pay a fair price for the A team, make sure the A team show up, and make sure you like working with them, and then it goes well.
Okay, Victor, anything to add?
Well, that's not my area of expertise, but an issue comes to my mind about underwriters who are afterwards rating the stock. I find there is a lot of conflict of interest in this, so maybe you guys could elaborate.
Is your name Spitzer?
Okay. What should a listed company expect from its independent non-executive directors? Chris?
I always advise companies, when they come to do an IPO, to attract two types of non-executive directors. One who's got experience of their sector, so they've been in the business, they've been there, done it, And then secondly, someone who's got experience of financial markets, either could be an ex-broker or could be an accountant and so on, so they can guide the company using their experience and become a sounding board for the executive team.
John?
That sums it up perfectly. Use your money to get people who are going to help you in the process. Don't put toadies in, don't put yes men in. Get people who'll give you the experience, because you've got to focus on running your business. If you do an IPO wrong, you can stop your business as you're doing because you take too much CEO time away from it. So make sure your NEDs are in place, make sure you trust them, because one, they're there to help you, but two, they're also there to verify to the independent investors coming through that the business is working well and is well governed overall. And the last thing to just add is get them in early. Don't wait till the last minute. Don't do a Vegas-style wedding when you pick up on the way. Get them early in so you can benefit from their advice and you have some credibility with them on the road.
And Michael, obviously being a very experienced independent non-executive director, what is your take?
Yeah, I don't like the word non-executive director. I've never had, because as you will know as a lawyer, we've all got collective responsibility anyway, so I've never really understood that wording. Independent director, external director really demonstrates what it's all about. Your job there is to challenge, to understand the business and be prepared to challenge the management, and of course be prepared to stand up and defend the rights of the institutional shareholders who effectively you're representing.
And given your experience in that particular role, what are the kinds of issues that you've experienced being an independent director, I'll use that terminology, on the boards of listed companies? What are the sort of concerns, thoughts that you'd like to share with the audience?
Well, there's a multitude of things, and as an independent, you're sitting on the audit committee or chairing the audit committee or the REMCOM or the nominations committee, so you have a pretty serious role to play, frankly, and for example, if I would take remuneration, just as a case in point, you may have some pretty strong views about the incentive plans that the company wants to put in place, whether they're appropriate or right for the type of business, or indeed should be put in place at all, depending on the nature of the business. So I think remuneration is an increasing issue. When we come to the audit committee, working closely with the auditors and with the external auditors, and again, challenging the CFO from time to time is an issue which comes up quite regularly, frankly, more regularly than you would imagine, and a series of others.
Mark, obviously, again, from your experience of advising listed companies, how important have you perceived the role of independent directors, independent non-executive directors, in terms of your interaction with them, or is it pretty much irrelevant whether they're in non-exec directors or executive directors?
I would probably say that on balance, the investor relations, the communications tends to be into the executive team, the CFO and the CEO, working with the other advisors, particularly the nominated advisor in a name, or broker or financial advisor. However, I think that actually is a pity, and that more could be made of relationships with independent directors. Taking the downside, if independent directors are, let's say, not properly vetted or rushed in a bit too late, sometimes, and I have seen that lead to rather unfortunate PR consequences, where you have people who do not have the right expertise, who say the wrong things, and that does create unfortunate public embarrassments for the company, which can affect the share price. On the other hand, often you see an issue with new management teams, particularly, dare I say it, with smaller companies, entrepreneurial companies, where the CEO and the CFO don't always understand what's expected of them from a public perception point of view. And having a close relationship with an experienced independent director can help to deliver some hard truths into a management team that can mean events might be avoided and dealt with in advance rather than played out publicly.
Okay. We're going to have a couple more questions, then we're going to open it out to the audience. How do you maintain interest in the company once it is listed? Victor?
Well, that's a very important point. First of all, by regularly updating the investor community, probably we'll hear more about that later, about the future plans of the company, and obviously being really, really focused on bringing this message as widely as possible, because even the smaller investors will not appreciate if there's some privileged parties which are getting this information in some way in advance, and it has happened. So I would really love to hear what our communication expert has to say about that.
I would emphasize that, obviously that would be a breach of the rules if that happened. I think that'll probably be John's first point. John, do you want to give a perspective?
Again, I think it's a relatively simple formula, is set expectations realistically in the market and outperform them, which means run your business well. If you set expectations as such where you can't reach them, trust will be destroyed immediately. There's nothing harder to do than rebuild trust in the market afterwards. So be realistic of what you can do, and then make sure you deliver it, and deliver it well, and then communicate as clearly and as concisely as you can. It's nothing more complicated than that.
Chris, I'd like to turn to you, and just before I do, I guess this point about how do you maintain interest in the company, the one sort of word we often summarize it from, I'm not sure if I'd call them disgruntled executives of listed companies, but certainly something that one does hear from time to time is liquidity. How does one deal with that challenge?
Obviously, I'm not a PR expert, and my colleague to my right is, but I always say to companies to maintain an active investor relations program once they are listed, and that means releasing good news. So if you win a contract or a big customer, release that news. That should then increase interest in the stock, which should increase, people start buying the stock, the price goes up, liquidity goes up, and suddenly you're in a virtuous circle. Of course, companies are under an obligation to release bad news as well, but certainly there's no reason why you couldn't enhance the positive news to increase share price and liquidity.
Before coming to Mark, Michael?
Yeah, it's news flow, I think, in a word, and that's difficult because not every company can produce a news flow every 5 minutes. There is always a cry, and we get it quite regularly in the companies I'm involved with, give us more news flow. And the reality is that things don't happen every day. They happen from time to time, and that's the way that the business works. And that's a criticism, but it's hard to deal with it, frankly. But at the end of the day, it's to do, as our colleagues say, with communication and doing your best to make sure that the investor base understands what you're doing and why.
Mark, I think this is your question.
Well, Johnny, of course, you just hire a good financial PR firm and the rest takes care of itself. But just joking aside, I think news flow is absolutely correct, having a good investor relations program, good contact with the market. But the mistake we see all too often with companies in the aftermarket once they've floated, and with the challenge of retaining interest, is how do they fill in the gaps in the news flow between their set-piece financial announcements? So if you're on the main market in London, you'll have quarterly updates that you'll produce. If you're on AIM, you only have to do it twice a year. So actually on AIM, there's only 2 events necessarily you have to communicate. Beyond that, it's things that may come up as and when board changes, new contract wins. So I think thinking about communications is not just purely financial communications, i.e. communicating only market events, but thinking of a company's wider corporate communications. So what is happening with their brands, with their business units, with their employees, that can create an interest and a buzz in a company outside of the rigid structures of the financial calendar, and having in place a program of events and activities throughout the year to promote the company in the business pages, but not necessarily entirely based just on very dry financial performance, but on more interesting sector themes, trends, and other interesting areas that may attract both investors. But the great thing about this, it also helps to reach customers, business partners, potential employees as well, and then creates much more beneficial profile for the company, which also helps to reach investors and drive liquidity.
Mark, thank you. Based on your experience, what is the one key lesson you've learnt that you would pass on to someone planning an IPO? Michael?
Oh. The one lesson, I think I've learned a lot of lessons.
You can have more than one, but at least
there's
one.
actually lots of lessons is the answer to that. I think, again, come back to what I think I said earlier, the lesson that can't be repeated too often is don't over-promise.
Okay. John?
I think we've covered it, but it's assembled the right team. Internally with your company, make sure you've got the structure. Don't try to do it by yourself as a CEO. Get a good CFO in place. Get your good non-executive directors in place. And then choose your advisors early enough that you get the value out of it. Don't try to rush this, otherwise you just end up getting hurt.
Victor, from a sort of slightly outside perspective?
I can only agree with John. And if you're going the IPO way, just make sure that you're not doing it just to cash out. Build the company.
Mark?
I would say don't come to market too early. Wait for the right time. Wait till you've got the right track record and the right mentality, and then press the button on the float.
Chris?
It's never too early to start planning.
Okay, you've heard from the panel. We'd like to open it out to the audience. Who has a question? I think a microphone's going to make its way to you. If you could just let us know your name and then ask the question, please. And also to who it's directed.
Good evening, Itai from iForex. A lot of the brokers that we hear now in the industry that are thinking about IPOs are regulated in Cyprus or other offshore jurisdictions. What do you think are the chances, I'm not necessarily talking about iForex, of floating a company regulated in Cyprus or offshore in London?
Okay, thanks, Itai. Chris, do you want to take that one? Hopefully the answer is yes.
I'd say there's probably no real barrier as long as, you know, the underwriters in London and the other members of the advisory team, the lawyers and accountants, can get happy that there is a valid reason for the company being registered in Cyprus or wherever. That shouldn't be a barrier.
John?
We have companies from 115 countries listed on the London Stock Exchange, so it shouldn't be a barrier. As long as you're willing to come here and observe the regulations, have good balanced disclosure done on a timely basis, and have a decent set of corporate governance, I'm sure you'd be welcome here.
Michael?
Only one comment. If you're a small company, or let's say a medium to small company, you may want to think quite carefully if you're coming to AIM, for example, about being VC approved or EIS approved, and that may be an issue if you're registered offshore.
Mark or Victor, anything to add?
I'll go. I think it's not an issue of incorporation, but rather of regulation. Specifically in the FX industry, I think it will take some more effort from CySEC, from the Cyprus regulator, to establish credibility, enough credibility for these companies. Of course, there are many cases where they have an FCA license, so that applies only to those who are strictly registered and regulated in Cyprus.
I mean, just to re-emphasize what John was saying, we do see Cypriot-listed companies coming to the market in London. In fact, we've listed several, and there are a number of companies in this particular sector which we're focusing upon at this conference who have certainly been looking at London and who have Cypriot jurisdiction or a place of incorporation. So, you know, if you're ready for the market, you've got a whole series of advisors here happy to talk to you. Any other questions? Just one at the back.
Hi, Stephen Leahy from 10. Similar to Victor, I seem to have left my voice at the bar the other night. For the gentleman specifically who focuses on PR, many of the firms in this industry are very dependent on volatility. No matter what your revenue model, many of us have volatility-based revenues. And so that's kind of like a one-trick pony. How does one deal with that in preparing for any sort of public listing or even talking to any sort of outside advisors? If you have a business that's so dependent on one variable that you really can't control, how does one deal with that when thinking about talking to institutional investors?
Mark?
Yeah, thank you. I think it comes down to being transparent and upfront about your business model at the start. Having a model which is volatile, which depends on trading flows, you could be, let's say, a gambling company where you don't know if a high roller is going to come in and win a large amount on the table or win a large amount online. And you see, even FTSE 100 companies, let's say William Hill and Ladbrokes, where there are significant variations in their model. As long as investors understand at the very beginning what they're getting into, then they will factor in that volatility. It's when, I'll give you a great example, more in the gambling space, but there's a company called Betfair, for example, came to market and it sort of sold itself as a tech company. It was going for the higher tech valuation. It wanted to have a 30, 40 times multiple rather than the 11, 12, 13 times multiple that you get for a bookmaker. That was all great until it warned in its first set of results that because of adverse weather conditions, the company was going to miss its guidance. Well, what tech company is influenced by the weather? Unless maybe a meteorological company. So it's all about setting expectations and at the very beginning explaining what you're doing and keeping to that. And if, for example, the situation changes, volatility creeps in a certain part of the business that you didn't expect it, you put together a strategy to explain to the market, come clean, get it out in the open, and then build a reputation strategy to bring yourself back to the right position.
Anyone else on the panel would like to comment, Victor?
Sure. I'd say that specifically to the FX industry, hedging is key, and I think that every company deciding to list should have a team dedicated to that, some specialists who could predict volatility, because it isn't an unpredictable factor.
John, anything to add? No. Okay, next question, please, if there is one. We got Mr. David Collins. Now I'm getting worried.
Hi, David Collins, Bowman Paisner. A sort of question, I think, for Victor, not just because I want to put more strain on your voice, Victor, but if I'd maybe start with a sort of, I guess, an observation from my perspective and then just kind of get your views on it. If I look at our experience in dealing with a whole bunch of online gaming companies, that's taken us into payment services businesses, CFD providers. What we've seen in those industries are, I guess, high levels of regulation, very fragmented markets, a finite market, albeit it may be a growing market, a very crowded marketplace, lots of people chasing for the same business, pressure on customer acquisition costs, cost burdens around regulation, taxation. I mean, it seems to me that this is another, if you like, sector or subsector that is ripe for consolidation on that basis, whether it's an existing listed entity or perhaps a new company coming to the market with a very credible buy and build strategy using the public markets to fund that buy and build, either using its equity either to raise cash to make acquisitions or, in fact, to use its shares as currency. I'd be just interested in your views on that and whether you see similar parallels.
Definitely. Hello? Yeah, definitely. I see these parallels and I agree on most of you said. I don't know about the gaming industry, but in FX, it's definitely a factor. And I really think that any company which is considering an IPO has to have something unique and something different. Otherwise, otherwise there would be virtually a cash cow for building a brand. And that's a very risky proposition.
Okay. If there's one more question, we'll take it. If it's looking around the room. Okay. Can I thank our panel? Can I thank John, Victor, Michael, Mark and Chris? Can I thank the audience as well? I hope you found it a beneficial panel discussion on, a very honest appraisal of IPOs in London, but also elsewhere. And if you are considering an IPO in London, I think hopefully 2015 will be a good year for IPOs, and we look forward to seeing you in London. Thanks very much indeed.